from California. What I want to talk to you about today is implied equity duration, and we're going to use it as a measure of pandemic shutdown risk. Some of you may know that I wrote a paper on this implied equity duration topic. We came up with the measure actually back when we were at Michigan with Pat and Mark Solomon. Mark was a PhD student at the time. And we saw an application back in earlier this year when the pandemic really got going in March to really try and understand how the stock market was responding to the pandemic. Let me see if I'm going to continue. I don't know if you can. And so we enlisted the support of one of our PhD students here, Ryan Erhard, and he helped us with doing a lot of the empirics. And we showed that it had a particularly we think like neat application to really understanding how stock prices are affected by pandemic shutdowns. And to give you an idea of the intuition here, I'm going to start with this quote from Bill Ackman. And we're sort of taking you back now to the middle of March when it became clear that this was something that we were going to have to take really seriously, and we're going to have to try and go into shutdown mode to slow the spread of the virus. And you can see we've got this quote on the left here. This is from March 18th, which was one of the days when the stock market really tanked down by about 6%. And Bill Ackman said, advice to the president, he's a hedge fund manager, shutdown is inevitable. And I've got a quote here that he made. Actually, he made this quote a few weeks later, April the 6th, in his letter to shareholders. And it really sort of highlights the intuition behind where we're coming from. And in terms of, obviously the pandemic had a terrible impact on human health and wellness, but also obviously the shutdown had an impact on businesses. And he says the revenues and earnings for the majority of businesses over the next year or so will be extremely poor and in some cases disastrous. But for companies with strong balance sheets, good market positions, and which do not need access to capital, the virus will likely only disrupt cash flows for the next 12 to 24 months. And then he gets to the point that really is relevant to us. In a DCF model, the loss or disruption of the first or possibly the second year of cash flows does not generally destroy more than 5 to 10% of the value of a business. So his sort of point is, for most companies, even if we shut down for 2 years and we get no cash flows in those companies for 2 years, that'll only destroy 5 to 10% of the value of the business. So at least from a business perspective, the impact sort of muted. And we're going to sort of abstract from the fact that different businesses will be affected differently and just sort of take this sort of statement at face value here, just as a thought experiment, and say, what if the effect really was to just wipe out the cash flows of all businesses for the next 2 years? Okay. Now, if that was the case, some businesses would get affected by more than others, because in some businesses, investors might have been expecting the bulk of the cash flows to come in the next 2 years or so. And they're what we're going to call the low duration businesses. But in other businesses, if you're like a business that's developing a new drug and that new drug probably isn't even going to hit the market for the next couple of years, it's not really clear it's going to have much effect on your business at all. And that's what we call a high duration equity. So you can see when we read this statement and when we were thinking about it, we thought, well, just as a sort of catch-all measure that you could apply across the board, this should be pretty powerful in understanding the impact of the pandemic. So the motivation here is to figure out which firms would lose a greater proportion of their value if all businesses essentially had their cash flows curtailed for the next 2 years. And this is where this implied equity duration measure comes in that we developed back in 2004. I should just mention at this, there's a fair bit written on this in the finance journals now, and at the time we had the paper rejected all the finance journals. We published it in Review of Accounting Studies, but since then it has been used in the finance journals. So this is something that seems to have caught on a little bit. It has been used since we published it in 2004. Now, we actually developed it for a completely different reason. Duration is commonly used to evaluate interest rate risk. And that's what we were focusing in our paper in terms of applying it to equity. So the sort of idea here is, if the Fed cuts discount rates and the cost of capital falls, then you should see stocks go up, other things equal. But the high duration stocks should go up by more, right? Because when you discount future cash flows, the further out in the future those cash flows are, the more of a discount you get. But as you cut rates, you know, the value goes up by more for those long duration equities. So we were showing that it was a good measure of interest rate risk or discount rate risk in equities. But here we're going to show you it's useful for a different purpose. And I'm going to show you a real simple example here. I realize some people in the audience may be real familiar with duration in fixed income securities, and others it might be a reasonably new concept. So what I'm going to try and do here is open up. I've got this really little Excel example. Can everyone see that? And I just want to show you three real simple securities and show you how this concept of duration works. So the first example I'm going to show you here, and I think you can see my cursor right, we've just got some flat uniform cash flows and they last for 5 years and it's $3 per year. And I got a discount rate of 10%. And when I discount those 5 future cash flows of $3 a piece, $15 total, with a discount rate of 10%, I get a value of $11.37. And what I can also do is compute the duration of that series of cash flows. And the way you do that is you multiply the year at which it's going to take for you to get the cash flows, T, by the present value of the cash flows, which I got up here. So T by present value, and then you sum them all up and you get the duration of 2.81. So this stream of cash flows here, you can see on average, you have to wait 3 years to get them. Their duration's 2.81. In fact, I'll just show you this because this helps some people with intuition. If I change the discount rate to 0, the duration comes to exactly 3 because 3 is right in the middle. Okay, but if I have a 10% discount rate, because the further out cash flows are worth a little less, the duration comes down a bit to 2.81. So you have to wait 5 years in total to get your cash flows, but on average, value weighted, you wait 2.81 years. Now, I'm going to show you another stream of cash flows below that, what I call the high duration cash flows, and they start low. Instead of starting at 3, they start at only 1, but then they climb up to 6. And I just sort of like set these cash flows so that they had exactly the same present value. So I wanted you to see this security is worth exactly the same $11.37 when you discount those future cash flows. But clearly it's a different set of cash flows. They start off low and they end up high. And when you compute duration for this set of cash flows, it comes to 3.6 years. Okay, and you see the intuition here, on average, you have to wait a bit longer to get those cash flows. So instead of being 2.81, it's 3.6. And finally, I've got like a low duration set of cash flows. So these have the opposite pattern. They start off high. I've started them off at 5 instead of 3, and then I've taken them down all the way to 0 by year 5. And again, I set them, I just played around with them, so I got them to be worth, again, exactly $11.37. So the value of this security looks the same as the others, but its duration's only about 2 years because you get most of the cash flows early on. So you can see, looking at the patterns here, you get the idea, base case, high duration, low duration, and then you see how our duration measure summarizes those patterns by telling you how long you have to wait to get the cash flows. Now, check this out here. What I'm going to do is I've got a little cell down the bottom of each one showing you how much the value of the security changes, and I'm going to toggle a couple of things. So first thing I'm going to toggle is the discount rate up at the top here. I'm going to take the discount rate. I'm going to do what the Fed did and take the discount rate down. So I'm going to take it down to 5%. Now, when I take the discount rate down, the value of the securities goes up, right? Lower discount rate, higher present value. So I'm going to put it at 5. But what I want you to see here, I've computed the percentage change in value of each security. You can see that this one went from 11 and change to 12.99. It went up by 14%. But the high duration went up 18% and the low duration went up by only 10%. Here you can see this is how you use duration in fixed income. The high duration is more sensitive to the discount rate change. If I take it up to 15, value goes down. And again, the high duration goes down by the most and the low duration goes down by the least. So that's how duration works. But that's not, that was our old paper. What we're interested in here is simulating a pandemic shutdown. So what I'm going to do next, I'm going to set the first 2 years of cash flows to 0, like Ackman was talking about. So let's delete those cash flows. And you can see in my base case, I lose 46% of the value. But in my high duration, I lose only 23%. And in my low duration, I lose 69%. And everyone get the intuition here, right? Because in the high duration, you're expecting to get relatively few cash flows in the next 2 years anyway. You don't lose much value. But in the low duration, you're really expecting to get most of the cash flows, so you really get hit there. And so that's the intuition we're playing with, and we're simply going to go out there, estimate duration for securities at the beginning of the pandemic and see indeed if the low duration lost more of their value. And we're going to find this is a pretty powerful way for summarizing what happens to securities. So let me get out of this example and go back to my PowerPoint. So how do we measure equity duration? If you haven't looked at the paper here, it's sort of, I showed you those patterns. What we're trying to do is simulate those patterns or come up with an estimate of those patterns for each security. And we use this formula here, which looks sort of complicated, but it's not that bad when you get into it. So we actually forecast future cash flows for a finite period. The problem with equities is, right, they don't have a natural stopping date. So we're actually going to set cap T to 15 years. We're going to forecast future cash flows for 15 years. And we observe the market capitalization again at the beginning of the pandemic. We see what the stock market's valuing the security at. And we say, okay, any cash flows that don't appear to be reflected in the first 15 years, we're going to assume that they're realized as a level perpetuity beyond 15 years. So we're forecasting cash flows for 15 years. And then we're looking at the price to infer what extra cash flows investors are expecting and assuming that they just come as a flat perpetuity beyond 15 years. How do we forecast the cash flows? Well, we use clean surplus and we basically forecast future earnings and forecast the growth in book value of equity, and then we infer the cash flows. So we're gonna say, okay, we can see current earnings. Let's use that to forecast future earnings using a residual income type thing, like a fade rate or an order aggressive process. And then we're going to look at past growth and forecast future growth in book value. And then the future cash flows is just our earnings minus the growth in the book value. So we forecast earnings using ROE with a persistence parameter of 0.39. And these are, you could do a lot better job. And actually other people have written papers trying to, estimate these parameters by industry and the like, but we're just using the same average for all companies just to keep it simple here. And we fade ROE to a long run mean of 12%, which is our discount rate. And we forecast G using, this is the growth rate in book value, using a persistence rate of 0.21 and a long run mean of 6%. And then we use a discount rate of 12% and as I said, T equals 15 years. So you just, Ryan plugged this in the computer and went through the beginning of the pandemic. We went to December 31st of 2019 and estimated these cash flows for all companies. And I'm going to give you just 2 examples to illustrate how this works. Actually, I'm going to do my special cases, then I'll do the examples. So just to give the intuition for this, I'll show you some special cases. If we were to assume that cash flows were 0 for the finite forecast period, our duration formula collapses to this here. It's just 15 years plus 1 plus R on R, where remember R is 12%. So that's one special case. The other special case is we could set the cash flows in the finite forecast period equal to the discount rate by the market cap at the beginning of the period. And then the duration formula just looks like this. And what this one means is you're just getting a flat stream of cash flows for the infinite life of the company. The cash flows in the finite forecast period and the cash flows in the terminal period are all the same. And it just looks like my example 1, a flat stream of cash flows forever. Then the other special cases we're really interested in, what if we set cash flows in the finite forecast period equal to the earnings for the most recent year? In that case, duration just becomes a simple formula that has negative the earnings to price multiple in it. And what we're trying to get you to see in this is that duration under this special case is just a simple negative function of the earnings to price ratio, which is a commonly used measure of value. And the other special case that I wanted you to see here is if the forecast cash flows in the finite period are equal to our cost of capital by the book value. from the most recent financial statements at the beginning of the duration computation period. And in that case, duration becomes a simple function of the book to market ratio. So this is going to become important later when we relate duration to value measures. But we wanted you to see here that under some simplifying assumptions, we can pretty easily show you that duration is negatively related to the earnings to price ratio and the book to market ratio, which are commonly used measures of value. And we're going to use this later on to show you we can understand how value stocks reacted to the pandemic, because value is just a noisy proxy for duration. So now I'm going to go to my simple examples, or my real world examples. We chose two companies from the auto industry. We wanted to show you that while this is going to pick up high and low duration industries, even within industries, it picks up high and low duration stocks. So this is General Motors. They're an example of a low duration equity. Their duration came out to 17 years. And these are the cash flows that we forecasted. And what happens with GM, right, is they've been very profitable recently, but they have a low valuation because investors don't think that profitability is going to continue. And they've also had negative growth. Their growth's been slowing. So they've been making some money selling cars, but they've been losing market share. And investors think that their profitability is going to wane in the future. So our forecast started high and went down. And you see a little kink here. This is when we went to the terminal value period. This is going to look much more extreme when we look at Tesla. But you can see the way our terminal thing here, we were forecasting cash flows that are about the same in our finite period as ended up in the terminal period. So it looks pretty smooth. Now, clearly, if you chop out the first 2 years of cash flows here, GM's going to lose quite a lot of value. If we do the same thing for Tesla, see a very different pattern. In Tesla, it was worth like $500, I think, back when we did this, $500 a share. Now it's like closer to $1,500 a share. It's actually gone up in the pandemic. But for Tesla, you see that we were actually forecasting, this is a company with very little profit. It's sort of break even in the past few years, but it's got high growth. And so its cash flows were forecast to be negative. And we forecast them using our algorithm to be pretty much only mildly positive out through the next 15 years. Given the huge value, what our formula told us, off in the distant future, in the terminal period, investors must be thinking they're going to make a lot of cash flows from Tesla. But the idea here is with Tesla, clearly investors aren't expecting to get their money back in the next year or two in terms of cash flows generated by Tesla. It's a long-term play. And so the pandemic should have relatively little impact on this stock. So that's the intuition. Some descriptive statistics here. We're going to focus on what we call 2020 as the first 3 months. And the reason we focus on the first 3 months is we're arguing January 1, people weren't really thinking the pandemic was going to be a problem in the US, at least, where the market we're going to focus on. But by March of 31, people realized this was a serious pandemic problem we were going to have here, and the shutdown was already underway. So that was the period over which investors' expectations came to reflect the shutdown. Just by a couple of things here, duration is sort of similar across, this is the larger sample period from 1964 to 2019, pre-pandemic, and durations just below 20 years in both of them. You can see the excess returns, which are annualized here, are negative 112%, because the market dropped by 30–40% in the first 3 months of 2020 versus positive 17% for the longer historical sample. I'm going to show you very quickly some correlations. This is at the onset of the pandemic, 2020, and you can see this strong negative correlation between duration and our value measures, and the positive correlation with growth, because you remember, like, higher growth means higher duration. And you could see a hint of our results to come in that duration's positively correlated with stock returns. Longer duration stocks do better. It's small, but we're predicting future stock returns here, so we never have huge correlations. If we go back, let's see, to the earlier period, so now I'm showing you correlations for the earlier period, you do see those same negative correlations with the value measures and positive correlations with growth, but you see a negative correlation with stock returns, and that's what we documented in our previous paper. So over the long run past, high duration stocks have done worse, but in the pandemic, at the onset of the pandemic, they did better. And here's the sort of like, I'm getting onto the results now, and this is sort of summarizes our main results. So I want to focus on this one, and then I'll see how much time I got left. What we've done is we formed 5 portfolios on duration. Quintile 1 is low duration, quintile 5 is the high duration. And what you can see here, this is the onset of the pandemic from January 2nd through March 31st. We measured duration at December 31st, and then we roll forward. And what we've done here is we've put in some lines to show you some of the big news events in the lockdown, like Wuhan lockdown, Italy lockdown, EU travel ban, and then the national emergency in the US. And there's the fiscal stimulus we got, where you can see the market going up a bit. But what you can see gradually as these events unfolded, the low duration, which is the green solid line down here, really started tanking. Whereas the high duration, they went down, but not by nearly as much. And you get this huge spread in the 30 to 40% range between these quintiles. So you can see it's really powerful in forecasting how stocks performed. I got a
Richard, did we lose him? I think we might have lost. Well, yeah, I think we lost Richard, so he might. We'll give him a second, see if he can join again. Greg, you might be up earlier than you planned. Oh, no, he's back. Sorry, Richard, we lost you there for a second.
You didn't lose me for that long, right?
No.
Let me just
if you want to check that, and then a couple of minutes, and then we'll take a couple of questions as well.
Yeah, I'm pretty much done here. Let me just see. So you can see me in.
And see the screen, yeah.
Okay, so what I'm going to do, I've got these pictures here, but I'm going to basically, this is my sort of final table before I get on to the conclusions here. So we're running a stock return, future stock returns over the 3 months at the onset of the pandemic on duration, and a bunch of control variables. We include industry controls, and you can see we get highly significant coefficient on duration. This is the annualized stock return across duration portfolios, 133%. And even when we throw in the industry controls, it remains at 104%. We show you that when we put into book to market or earnings to price, these value measures, you remember they're negatively related to duration, you get a similar negative coefficient on them, though it's slightly weaker because they're noisy proxies for duration. So I got some little pictures of it. So just to conclude here, you know, what we found here, if the intuition holds true, it's like a really simple and intuitive tool for understanding how stock prices are affected by shutdowns. The spread between the long and the high and low duration being 36%. You could also understand, you know, why value stocks have underperformed during shutdowns. You know, a lot of value investors are stressed out. Their value stocks have underperformed massively, and some of them wonder whether it's a temporary thing. And the message we got from this paper, well, if the shutdown does last a year or two, then it's just bad luck for the value investors. Their stocks are going to lose more value. And the final thing, this is more interest to the finance crowd here. People have wondered why value stocks earn a premium historically. And there's an explanation here. And in fact, there's some theoretical papers, we've referenced one of them here, that sort of like talk about this explanation. And that you can think of value investing as like, you know, they're sort of picking up pennies in front of a steamroller, in the sense that, you know, during normal times you get a little bit of a premium, but if any disaster happens that just cuts out the cash flows for the next year or two, your value stocks, you know, which is, let's face it, when a disaster like this happens, that's when you want to preserve the value of your portfolio, right? So you can make up for lost income, but this is exactly when the value stocks do the worst. And so there is risk in value stocks, and that risk manifests itself just when you least want to have risk, downside risk, when the economy faces a disaster. I just want to finish off with one final thing that I wanted to show you, which I just thought was a fun thing to show you here. Goldman put out a report just yesterday. You may have seen this in the news. I got this off of Bloomberg. Goldman says COVID-19 vaccine approval could upend markets. And I've just sort of like highlighted this area down here, where what they're basically saying is when a vaccine's discovered, let's say they announced the discovery of a successful vaccine that's going to cure us all, and we all hope that's going to happen, but they're saying what that's going to do is it's going to send interest rates up. It's going to help traditional cyclicals and banks, which are the low duration stocks, and it's going to hurt technology stocks, which are the long duration stocks. So I just thought it was interesting just yesterday to see Goldman sort of like, they don't sort of know about our paper, I don't think, but they were sort of talking the same intuition, how when we get an end to the pandemic, which will hopefully come soon, what that's going to do is lead to a rally in the low duration stocks and possibly a decline in the high duration stocks like the technology stocks. So sorry about that turbulence during the middle of the presentation there. I'll blame it on Pat using up all the internet at our house here. She's sitting downstairs, probably surfing the web or something. And I'll open it up for questions, turn it back to
No worries, thank
Emmanuel.
you. Thanks. John, I have a couple of questions.
Aloha, Richard. Both you and Pat are my American idols. Sorry, I should say Australian idols. And I have 3 questions. My first question is, I think you kind of, sample period is kind of too short. You only use the first 3 months. Maybe you can use the financial crisis of 2008, 2009 to kind of have a longer time period. My second question is, what's the impact of free trading and the COVID lockdown on stock return and the stock volatility? Because of free trading, people trade more. Because of lockdown, people becomes kind of like a day trader. My third question is, I really like your Excel example. I do not like your pharmaceutical example. You mentioned that pharmaceutical companies has a long duration, but if you are a pharmaceutical company focusing on COVID vaccine, it probably has a short duration. So these are my 3 questions.
Yeah, so yeah, just on the financial crisis, there was a paper in JFE by Weber that used our measure of duration and looked at the crisis and the financial crisis. And one of the interesting thing was they looked at, Weber had looked at, several past recessionary periods and found, in fact, if you read, you have to sort of read between the lines, but what you can see in that paper is a similar effect was observed in the financial crisis, in that the low duration stocks got hit the most, but not in the recessions before that. And he sort of suggests a sort of behavioral reason for that. So he doesn't sort of really hit on, I guess that, in my mind, the pandemic shutdown is a little bit more unique in that in the financial crisis, some businesses and consumers were hurt more than others, but it wasn't like we all had to shut down and couldn't go out and, do business as usual. It was more selective in who it affected, even though there was clearly a broader GDP slowdown. But that's a good point, and you can see the same patterns for sure. I jumped over the risk results, and what we saw, was that in long past history, the high duration stocks, the growth stocks, if you like, they're the ones that have been the riskiest in terms of beta and idiosyncratic volatility. But at the onset of the pandemic, that flipped around. And we saw, it was the banks and the consumer cyclicals, the retailers, a lot of the low duration stocks, the airlines. I mean, there's a lot of the energy companies. These are sort of like the low duration industries and the low duration stocks that were the riskiest. One of the things, it's funny, that I think Ryan was telling me that on August the 16th, he thinks, in words, we're going to get the next 3 months of stock returns off of CRISP, right? Something like that. So we can extend the sample period and we'll do that when we get the stock returns. And we could probably get them other places, but we just thought we'd wait. But the 3 month period was most interesting to us because we wanted the period where, you could say, we want to go back as far as people really weren't pricing in a shutdown. And then when we want to stop it when people had realized there was going to be a serious shutdown. And I think, in my mind, since March 31st, it's not clear to me whether people think the shutdown is going to be shorter or longer than they were thinking back then. Sometimes we get positive news, sometimes we get negative news, but it's hard to say that, as of today, whether you know, the shutdown is going to be longer or shorter than we thought it was back in March. So it's hard to have a good a priori prediction about what. And the other thing you've done, you know, the Fed's been changing discount rates, and the market's been priced, you know, discount rates are changing, and so that's affecting stock valuations too. We have this puzzle now that the stock market's sort of flat, right? Since the beginning of the year, even though we've had this pandemic shutdown, and you think, well, how does that work? And one of the things we think plays into that is the lower discount rates.
Great, thanks a lot.
And
Thank you.
Cheers. And we'll take a quick question from Amir as well.
Yeah, hi, Richard. Thanks for the presentation. You kind of answered the question, I think, with the Bloomberg article, but I thought about like what you would think about how these stocks will recover. So whether low duration stocks would recover faster than high duration stocks, because value investors are usually kind of concerned about value traps.
right.
And these low duration stocks are essentially, given your example, are kind of stocks in decline. So whether there's a way of distinguishing whether these are kind of declining stocks or actual value stocks, and how you would think about that.
Yeah, I think it's a great question. You know, this isn't, you know, I think we'd put this forward as sort of like a neat, simple measure. And this is what we do as academics and quants, right? For just sort of summarizing these broad effects, but you'd really have to dig into the individual stocks and the industries to try and figure out whether or not, you know, it's a value trap. You sort of have to think about what, you know, how they're affected by the shutdown and how they're likely to be able to recover and how long it's going to take. So, you know, I would just sort of point out that I don't think there's like a simple measure that you can use to perfectly predict how stocks are going to fare. And you just have to do more detailed analysis. But the one thing I just sort of would point out is, you know, like one of the things that the value investors are looking to for hope right now is that the value spread is wider than it's been, I think, to just about any time in history. That is, you know, but so they say that's an opportunity for value investing. But the thing that I want you to see is, of all the prior times you might go to in history, this is a time in which past earnings might be the least useful in informing you about future earnings. And if that's the case, you'd expect value spreads to be the greatest, even if stocks are correctly priced. So, you know, you look at many industries like airlines and cruise lines and energy, and they were profitable last year, but are they going to be so profitable this year? Probably not, right? And so you would expect the value spreads to be big. So I wouldn't be too hasty to conclude that big value spreads mean a rebound for value. It more relates to, you know, whether we get a vaccine quickly or not.
Thank you.
All right. So just in the interest of time, Greg, do you want to start your presentation?
Sure. So I'll do that annoying thing and say my sharing is working, correct?
Correct.
I was trying to sign in on my phone so I could check it, but thanks. You know, it's always tough to follow Richard and Patty's work. And then as he was going through this stuff, it reminded me of sitting in on his class when I was a PhD student at Michigan and watching him do all the math. We're going to use mostly pictures to tell our story. You know, Richard's seen me do math, so he'll understand why. And our paper has nothing to do with accounting pretty much. Jim was saying that when we did this, he feels like when Ford pivoted to make ventilators, we're taking the skill set that we have, but applying it to something different. And when COVID started, both Jim and I were very interested in kind of the unique perspective that business and work has on it. A lot of people were focusing on the drugs, what do you do, et cetera. But you know, the economic role, and then also just kind of the role of businesses in impacting what happens here was interesting to us. And so it's not moving forward for me here. So we came up with two research questions, and really we just have one. The big research question is, the more we thought about it, the more we thought, does the act of physically attending work impact your social distancing or not? all of our, or a large portion of our ways of dealing with COVID right now, because we don't have a vaccine, et cetera, have been based on physical distancing or social distancing. And yet the problem is much of what we do for work has to have you involved with distancing. Now, there is some work on flus, et cetera, trying to do distancing at work, but we wondered whether there was a broader impact as well. That did mean we had to answer a first question, which is, did COVID even impact who's physically attending work or how it's happening? And so the way that we went about doing this was that Jim, to give him full credit, went out and looked at all of the different service providers that give you cell phone data and mobility data, and he identified Place IQ. And what Place IQ does is every time that you use your phone to access something like the Weather Channel on an app, and you've got a bunch of people doing that, Place IQ gets information from them, assuming that you've clicked that thing that says allow them to collect information. And we're just picking Weather Channel as one example. We actually don't even know if Weather Channel is an app that Place IQ uses. There's all sorts of anonymity that's built into the process, but they have several hundred apps that they get feeds from. And every time you walk around with your phone and use it, if you're somebody who's letting them collect the location data, they get it. And then what they do is they aggregate all of that and they put it to a feed that we have on an Amazon server. So to tell you a little bit about that data, we get this almost a raw feed of everything that's happened. What they do is they take each device and they've got a hashtag for it. It's an internal device, so we can't tie it back to your phone, but it ties all of your visits together in there. A timestamp, it has a latitude and a longitude that actually get you down to about 1 meter of distance. So it's very, very accurate of where you are. The number of locates around you, the minimum time that you're there, did it ping once? Did it ping multiple times? They look at how quickly you're moving. And if you're not moving faster than what they consider a slow walk or a brisk walk, they call it a visit. If you're moving faster than that, where you're in a car, they call it a trajectory. And if Jim was here, he could get you into all the details. There's a ton of work to take all this and put it all together. But that's one part of the data. And we're going to use that to determine a home location and a work location for people. So we can figure out, did they stop attending their work location as we move forward, and make sure that we weren't picking up their home location and calling it work, et cetera. And I'll show you how we did that in a minute. But then the other database that they have, which is really what most of their commercial clients want to use, is they've got these attributed visits where they've gone in and they've identified where a location is. So the location might be a car dealership, a McDonald's, a grocery store, et cetera. And they've identified a ton of these and nationwide. And so what we're able to do is use that attributed visit and tie it together with our unattributed visits to see, are people visiting places outside of their work? And we can put them into categories to see what kind of visits they're making. So the first thing we had to do is figure out, where do we think you work? And make sure that it's not your home. So what we did was, for where we thought you worked and for home, we chose Tuesday, Wednesdays, and Thursdays, middle of the work week. So we're not worried about picking you up on vacation, et cetera. We chose 20 of them randomly between October and January. So before COVID started, to see if you were consistently at a place. And we started collecting data on your visits. For work, we did any time between 9 a.m. and 3 p.m. So where were you all during those times? And for home, we did from 12 a.m. to 4 a.m. And there's some technical details on picking up first and last pings, et cetera. But we use something called DB Scan, which is a algorithm that allows you to put locations together and then clump them to say, yeah, these weren't exactly the same place, but the way that they're clumping tends to make it appear that this is a cluster. Then we made sure that your home was at least 1 kilometer away from your work, so we weren't getting some sort of mistake there, that we didn't come up with multiple work locations, which means we don't capture somebody who travels for their work, et cetera. And then we also tossed out public schools. As we started going through the data, we thought, wow, there's a whole bunch of people working in some of these places. Then we went out and they were unattributed places. We went out and figured out, oh, well, those were schools. So we used national data on school addresses and tossed all of those out. So we ended up with about 2 million devices that satisfy all of our criteria. And it probably works better from the few of your faces I can see right now. You're giving me the, I don't know what you're talking about look. So let me give you an example of how we do this. So here's a map, and what you see is all the pings that we got for this person, over this time period. And so the first thing that we do is we come up with all these locations during the training sample. So during those 20 days during that time period, and here we were figuring out work. So it's between 9 and 3. Then we use DV scan, and it went and said, look, 3 of these appear to be clusters where people are frequently at them. And so those are ones you should narrow down. The rest of them are incidental things. They weren't at that frequently. We kept clusters that were visited at least half of the training days, under the idea that if it was work, you'd have to be there consistently. And so you can see in this example, we lost the other clusters once we did that. So we went from having 3 clusters down to 2. Then we did it for your home. And what we figured out is one of those clusters was actually the home. They were there sometimes during the day, but at night they were there very consistently. So then we tossed out any devices where the home was closer than 1 kilometer to the work to make sure that we weren't just screwing up our clustering. We also tossed out ones where there was more than 1 home or 1 work cluster. There weren't that many of them. And early on, it takes forever to run these results. But early on, we made sure our main results were robust with that. But it does confuse things. And so we were trying to get people we thought we had really clear identification on. Tossed out the public schools. And that led to this sample. So then once we have the sample, we can say, well, do we stop seeing you attend work at some point? And so this is where I promised you the pictures. Here what we have is a graph starting back in January of work days, so Monday through Friday, of whether people are showing up in that work location or not. And what you can see is that on Mondays and Fridays, they're a little lower. Tuesday, Wednesday, Thursday, they tend to be more frequently there. That's Martin Luther King Day. That's President's Day. So it pretty much matches what you would expect as far as seeing people in work. And then what you start to see is as COVID started to become a more serious issue in the US, people stop attending work and it drops down and then gets kind of stable. But we can see a huge drop from being there on average about 80% of the days to only being in about 40% of the time. So this is that first small question. It shows us, hey, there really is a change where about half of these people stop attending work, on a regular day. So we see that people aren't physically going into the office. Now, we clustered this around events, and you saw in that picture we had lines for things like school closings, et cetera. We wanted to see how much did these mandatory events impact it. And what you can see is schools closed first in most states, or was one of the first things. And you can see a whole bunch of people's last day of work. Here we're looking only at people who stopped going into work. Their last day of work was actually just before schools closed. So we get a big clump there. Now there were people who stopped going into work prior to that. And there's a bunch of people who kept going into work, but then stopped later. The large gathering band, again, you see not quite as clean of a picture as schools closed. And in a lot of states, these and the school closings were pretty overlapped. So these aren't independent. Restaurant restrictions, again, a little before those, couple day lag. The interesting thing to us is like the non-essentials being closed. By that point, most people had stopped going into work. So those didn't have as big of an impact on going into work as what we would have thought. And as we're thinking about trying to open the economy back up and make things work, it's interesting to note that those didn't have as much impact. So this allows us to get some sense that there's a voluntary group, and then there's a group that are more likely to be responding to some sort of an external compelled to stay home. Okay, so now we understand about people staying home. We can get to the question we really care about, which is, does staying home from work impact other decisions you make as far as visits that you make? And this is simply, no controls in here or anything else. The dashed lines are people who continue to physically attend work, and the solid lines are the people who stop attending work. And we look at this, and what you can see is in this first group, what we call staple goods. Staple goods are grocery stores, pharmacies, things that you really need to do for continuing to be able to exist. And what you can see is you would think, well, those shouldn't be that much different between the two groups because everybody has to go to the grocery store, everybody has to go get medicine, etc. But the people who stay home after, in the pre-period, they were doing exactly the same thing. But then after COVID gets bad, those people make fewer visits outside of their home. And it's even more extreme if you look at something like other retail. So these are like going to the mall, going to the store, etc. We can see it with dining out. We can see it with coffee, although it's not as big of a difference there. The people who stay, continue to work, just are out and about a lot more. And you can even see it here where with dollar stores, those people were actually attending them less. And then we get this flip where they continue, they drop off what they're doing, but they drop off by much less than the people who started to stay home. So that's just in a simple way. We thought, well, people will say, well, it could be different parts of the country, could be different opportunities, etc. So we ran a fixed effects model. We put in weeks, we put in stoppers, we put in specifics about location, etc. So there's a whole bunch of controls in there. And then what we did was run a regression just to compare the behavior each week. And what you can see is for staple goods, for example, they're statistically equivalent until they start to stay home. And then what this is doing is the base case are the people who continued working. And you can see the people who stopped working, stopped making as many visits. It's pretty massive for other retail. Coffee, it's smaller, but there wasn't as big of a change to begin with there. So we look at this and say, okay, even in this careful regression, we can see that people who continue to go to work are out and about, going a lot of other places, facing vectors of infection and potentially spreading vectors of infection as well, since they're the ones who are out and about more, the people who are making more of the physical connections across these kind of weak networks. Now, every accounting researcher at this point is thinking, sure, and it's self-selection. I'm watching Emmanuel's face and he's thinking, uh-oh. So of course you worry that what people have here is some sort of a difference in risk preference. But there's some ways that we can deal with that. Remember back where I showed you, hey, a bunch of these people stopped working just when schools were closed? Our argument is those people were compelled for some reason to stop working. The main reason that we would argue is maybe they had to watch their kids, for example. So we can compare the people who voluntarily stopped going to work before there was any sort of a government requirement in their state to the people who stopped working the day before. And what we actually do is take people who stopped working a week before the schools closed, and then people who stopped working the day before the schools closed. And we've got the pretty pictures. I'm just going to show you the graphs from the regressions here on out. And then just to complete the circle, we can also compare those compelled, who we would argue they're not stopping for risk preference. They're stopping because somebody has imposed a cost on them, to the people who continue working. And if we see that the voluntary people are similar to the compelled, and in the periods where they're both working and different when they're not, and the compelled people are similar to the continuers in periods when they're both working, but when they're not, they're different, then we're trying to tease out kind of the risk portfolio. And, what you see is that's exactly the case. So here we've got the means of the coefficients, but also the 95 and 99th, so 1%, 5% sort of the coefficient distribution. And what you can see is for staple goods, the compelled versus voluntary, we're visiting at exactly the same level statistically until the week where the voluntary stay home and the compelled keep working. And then when the compelled start to stay home, and remember, they were compelled to do that by a change imposed on them by the outside, they stop making visits outside the home and the two become much more similar. Now, we still see a little bit of a tail here. This one actually is not even statistically significantly different. You can see from our little tags here. This one, there's a little bit of difference that remains. So there may be a little bit of risk premium here, but there doesn't seem to be that much. And so really the big impact is that when one group's working and the other group isn't, they're very different. And once they both end up in the same situation, now both aren't physically attending work, we see that both stop making other visits as well. Now to complete the loop, if we compare the compelled to the compelled to the continuers, what you see is they're exactly the same until the compelled stay home. And once the compelled start staying home, they drop way off relative to those continuers. Okay, so if that still doesn't convince you, the next thing that we did is we took commuting distance. And we said, look, people with long commuting distances have an economic reason to stay home and basically use this as an excuse to avoid that long commuting distance. And so we compare them. And just to show you another little picture, the ones in the bottom here, those are the ones who commute. And you can see that they do stay home more. We did the same breakout, voluntary versus compelled. And what you can see from the picture is, even though they had an economic transaction cost reason to stay home, their behavior is the same. When they're working and the other group isn't, there's this big difference where the people who stay home are making more visits. And then afterwards, when they become more similar, they become the same again. So even with that economic cost, now you've been compelled, plus you had an economic cost to make it more valuable for you. What we see is it's the staying home from work that actually drives what your behavior is, not all of those other costs. To finish the cycle there, you can say, well, I still think those people are different. So we took the continuers and stayed within the continuers. So you're a continuer and you're still going to work. Did you change your behavior? And what we did there was we set every week the same so that, we set controls for every week so we can observe, does their behavior change over time as COVID becomes a bigger issue? And we centered them around when the school closed in their state. And what you'll see is that prior to COVID, on a day that they worked, they were less likely to go to staple goods, less likely to go to retail, less likely to do everything. And then after COVID, they switched to where they're more likely to make those visits on the days that they're out of the house and less likely to make them on a day that they did stay home. So even within one individual who continues to work, we see that leaving the home to go to work impacts when they make visits to other entities outside of their work, which increases the vectors of exposure that they have and the way that they spread it to other vectors. All right, one last finding. When we brought this up, people were saying, well, maybe what you're picking up is socioeconomic differences. Some people can work from home, others can't. And when you run this just broken on socioeconomic differences, you do see people from high socioeconomic backgrounds make fewer visits outside of the home, particularly after the COVID period. And so it seems like in a naive model, maybe we did just pick up socioeconomic differences. You have to go out to work, you don't have funds, etc. But what we did was we created, and I don't like all these interactions, but we created a four-way interaction here: low socioeconomic, high socioeconomic, based on your census data location, and then whether you continued to work or whether you stopped to go to work. And what you see there is that if we condition where the comparison here is low socioeconomic who continued to work, you can see this is the high socioeconomic who continued to work. This is the high socioeconomic who continued to work. This is the high socioeconomic who continued to work. Let me just close this down. Again, high socioeconomic who continued to work, high socioeconomic. The high socioeconomic who continued to work is very similar to the low socioeconomic who continued to work throughout. These are the low and the high socioeconomic who stopped work. Low and high socioeconomic who stopped work. Low and high socioeconomic who stopped attending work. And what you can see is whether they continued attending work or not had a much bigger impact on whether they made other trips outside of the home. Now we do see for the low socioeconomic who stopped going to work, they do make more trips outside their home. And there is other research that would say they don't have the same financial backing to be able to buy their way out of making some trips. So for example, they can't go to the grocery store and load up for 2 weeks. you know, if they need to pick something up from the hardware store or whatever, they can't just go out and buy all the masks that they need, etc. So it's not driven by socioeconomic. And in fact, even though in many, many models you see socioeconomic is one of the main determinants of what impacts people's actions, here what we see is whether you continued attending work or not actually is much more descriptive of whether you're going to continue to make other trips outside the house. All right, so summary, what do we think we found? Physically attending work is highly associated with making other trips outside the home. It doesn't appear to be attributable to risk preferences or to other socioeconomic status. And what this means is, as policymakers are thinking about how do we open the economy, you know, they really need to make this a clear trade-off, because they're thinking about how do we open it and keep people safe at work. But with a lot of the stuff we're seeing, whereas we've been opening up economies, people are going out and doing a bunch of other stuff. This seems to suggest that actually having them attend their own work makes them feel more comfortable with going out and making these other visits, or leads to them going out and making these other visits. So we may want to think about ways to set policy to deal with that. I know I ran through it quickly because we didn't have a lot of time, but if folks have questions, I guess I'll keep sharing my screen in case people want to go back to it. But.
Yeah, sounds good. Thank you, Greg. All right, so we'll start taking a few questions and comments. John Barrios, do you want to?
Aloha, Greg. I have a couple of questions.
Okay, we'll start with
My first question is, will the status political identification, like how they vote in the 2016 presidential election, have an impact on the social distancing and the face masking? And my second question is, you talk about 6 types of activities. Do people do this kind of activity on the way to work or on the way back to work? Will this have an impact on your results?
So to answer the 2 questions, we chose not to delve into the political part of it, but in our regressions, we have it down to the county level. So to the extent that there's any political part in there in the regressions, that would be controlled away. We can't observe the individual's political background, but that would control for any difference in political view at the geographic level. The second part about do people do this to or from the way of work, recall in that last risk preference part that I was showing you, we were looking within the individual. And what we saw was prior to COVID, they tended to do these things on days they didn't go to work. And after COVID, they tend to do them on days they do go to work. So there's been this switch in behavior. What we would argue is when you leave the house to go to work, yeah, you're likely to do other things, but there's already this kind of mentality, hey, I'm out here. It's not a big deal to stop and get a coffee or to grab food or whatever.
Thank you.
Did you want John Barrios now?
Yes, I just saw Barrios had a comment question.
Cool stuff, Greg. I think one maybe another data set, given that that Jim is working with all these data sets, is an ex-colleague of mine has the stuff on like the ease with which to do the job at home. So like the teleworking, and they classified all the jobs based on the occupations by the ease. So they have I sent the link up on the chat so you can just send it to him or take a look. And they basically show that is good at predicting, you know, which of these counties were more or less social distancing. And I think maybe one thing that it's not a bad thing, but I think you're picking up potentially, at the worst case, you're picking up a better measure for kind of the socioeconomic stuff, because you could imagine that people with low income would be in these jobs that they can't do from home, that you have to like go, like these frontline workers that are doing service jobs. And that's kind of, I like your social, when you were doing like income, you have a less noisy measure, right? And so whether it's risk perception or you're capturing that in areas where these places, these people are doing these jobs, they're like your story, right? They're behaving riskier. But I think it would give you like a nice kind of like variation with the job level. And since you have the name of the businesses, you can match based on, for at least a subsample of these individuals.
So it's interesting. We'll take a look at it. We don't have the names of the businesses because remember, we found their businesses in an unattributed database. So we know the location. And one of the things we figured out is if you go to a big city in a skyscraper, for example, you know, you're getting all sorts of businesses in there. And we do have, because we have the county control in there, absent being able to identify the specific business, at least if there's a difference across counties, hopefully we've controlled it away. But I do appreciate seeing that, because Jim is unbelievably good at taking data and being able to put all of this stuff together. I mean, the programming that it takes to deal with these hundreds of millions of observations. And then, I asked him, well, you got all the census data, and I swear within an hour he had it put together with the census data. So it will be interesting to see. Plus, I'm just interested.
Yeah, just a simple partition, for example, by the percent of the occupations in the county, rather than fix it or affect the way you could actually see that these counties where you have a lower proportion of jobs that are, that you could do telework, then you see your effect there. Like that could kind of give you at least a little bit more meat, rather than just say that it's in the fixed effect. Thanks.
Yeah.
Cool.
Yeah, I like it.
Thanks. And I know we're nearly out of time, but Francine, I think you had a comment if you wanted to.
You're muted, Francine.
I was just thinking about sort of whether or not this, you could think about this.
You muted yourself again.
Let me just go back to my original question. There's a lot of discussion, a lot of writing about how commercial real estate is crashing and companies are reconsidering whether they're even going to go back to the same space and are, getting out of leases and things like that. I mean, what if people don't go back to a traditional office? What if they really, find new ways to be working at home? What is the potential for more occupations to be moving to that model? And how would that affect some of this consumer activity?
Yeah, I think there's an interesting, there's all sorts of really cool stuff with this sort of data, but I think it's an interesting question. Has this created a shift that, because we can see, and there's research, there's a paper in Science and a paper in Nature that show that mobility, and particularly within cities, is pretty consistent. So people follow kind of the same mobility patterns on a regular basis. And the fact that this has punctured that mobility pattern, there's just an article today, I think in the Wall Street Journal, about how many moving companies are moving homes out of New York City. What does that mean? I think interesting longer term than this paper, but it would be something that we could potentially look at with cell phone data. Did we see a shift in the mobility? For this paper, where I think what I think this paper can do is, if you look at companies like Google, for example, has just said, our employees will stay home for a year. I think this paper supports that idea, because it shows that what Google is doing, and part of the reason Jim and I got interested in this, is what role can companies play? And when large companies say, we're going to try to keep employees working remote, what our paper would say is they're helping to contribute to the ability to reduce social distancing and to the way that people think about social distancing. And so I think it supports a lot of those decisions. They didn't see our paper because it's not widely circulating. The sorts of journals you send this to have media bans when you submit to them, which we were not familiar with. That's why E can't share the paper with you either. But I do think there's an implication there. E, did you want to take any other questions, or?
I'd say, given the time, we'll close it there. We've got it recorded. We'll also, if anyone has any additional questions, obviously, please feel free to reach out to the authors. Thank you again to Richard. Thank you again to Greg. It was really interesting today. Next week, we do not have a webinar, but we're back the following week, August 21st, with John Graham and Oliver Benz. But I'll send everyone an email about that. So thanks again. Please communicate with the authors if you have anything particular or any other questions, and have a great weekend. Thanks a lot, guys.
Thanks, Emmanuel.
Thanks.
Yeah, thanks, Emmanuel. That was great. Just moved in.